Our subject is managing marketing and financing strategies in Africa. I'm the moderator for this interesting segment. My name's Thomas Miller, work for PNC Bank, Capital Markets. I'm actually in the foreign exchange side of the business at PNC. Sit here in Indianapolis. I've been with PNC since 2004, covering markets through Indiana, Kentucky, Tennessee, and manage the Chicago Foreign Exchange Trading Desk for Chicago and Central Illinois. We have three wonderful speakers here, and I'll introduce them in turn as they start their own brief presentations, and after all three are done speaking, we'll open the floor to some Q&A. The first speaker today is my colleague Randy Good. He's sitting in the middle there, the good-looking guy with the blonde hair. Randy is a senior vice president of international banking at PNC Bank. He also covers Kentucky and Indiana markets and a lot of other markets as well through the business credit portion of the bank. He has 45 years and then some of international banking experience and managing also international teams. He has developed export financing solutions for clients and their foreign buyers through the use of various U.S. government programs. After serving in the U.S. Army, Randy earned a Bachelor of Science in Business Management from IU, and additionally he holds a various number of certificates, including the Export-Import Bank of the United States Certificate of Accomplishment. He's also been awarded the designation of Kentucky Colonel for the Commonwealth of Kentucky, and he's the recipient of the Bell Award for being a community volunteer with youth. He is a past member of the Executive Board of Directors of the Kentucky World Trade Center. He is ex officio member emeritus of the Kentucky District Export Council of the United States Export Assistance Center of the U.S. Department of Commerce. His credentials go on and on. I'm proud to have been his colleague for so many years. We've known each other since I started at the bank here in 2004, and we've done a lot of work together. He's going to share a lot of wonderful insights into the world of trade finance, specifically around issues in Africa. And with that, I'll turn the board over to Randy Good.
Thanks, Tom. Is this working? Can you hear me? Good morning to all of you. It's good to see you. I assume that each of you have looked at your products, determined that they are products that would be suitable to sell and to sell into Africa. So you've done that kind of work to get started into exporting, and now you got to start looking at, okay, what are the duties I have to be able to export? And I think the first thing that is important is compliance. Have you looked at your compliance programs to see that you have means to verify who you're doing business with in Africa, the KYC, AML, anti-money laundering issues that our government asks us to do, and then knowing exactly who the end users of your products are going to be. We're all charged with the duty to check those issues and make sure that we do know where our product's going, what it's being used for, so that we're in compliance with U.S. law. That includes reviewing the designated nationals list, terrorist organizations, to make sure who you're doing business with is not involved, or supporting that in any way. We, PNC, have to do the same thing on all transactions that flow in and out of the bank, regardless of what form that they might come through us. And so we're pretty thorough on that process as well. And I think once you've done that, then you find your buyers, and you got to look at credit risk. How do you view credit risk? And credit risk is who you're selling to. How do you get good financial information to know whether or not this is a party I want to sell to, I can sell to, get paid, because there's no point in selling if you can't get paid, in my opinion. And then you I think that's probably the most difficult thing is in what you're going to be looking to do. There's still a lot of low income issues in Africa, and people having the capital to be able to purchase and do stuff. So you got to make sure that you do have a good view of that. And then you got country risk. And country risk is totally different than credit risk. Country risk can be things such as, do they have foreign exchange convertibility capabilities to be able to take their currency, exchange it into dollars to be able to get out of the country. is there likely inflation or deflation, more the case, where the cost of your product goes up exponentially, and now it's more difficult for them to pay. And so you got to look at that. You got to look at any kind of wars, insurrection, invasions. I'm going to give an example of something that we are all aware of, Kuwait. You know, we all view Kuwait as being a very oil-rich country, a lot of cash and so forth, and people who were doing business with Kuwait had problems when Iraq invaded Kuwait. Kuwait couldn't get money out of the country and make payments, and if you had even transactions through their New York branches of their commercial banks, they couldn't make payments either because they're funded from Kuwait, and that can create issues. So understanding who you're dealing with, what those issues around country and credit risk are really important to you. And then as you look to see, okay, how am I going to sell my product? How am I going to get paid? There's different forms of payment mechanisms. The best from an exporter is cash in advance. And, you know, sometimes that works. A lot of companies I know try to use cash in advance when there's selling into higher risk areas of the world where they are concerned about credit risk, country risk, those kinds of issues. But a lot of times that inhibits the amount of sales that you can make overseas because it's hard for people to come up with a product. You're looking for improving your cash flow, so is your purchasers overseas, and so trying to find ways to help them. Confirmed LCs would be the second mechanism that would help you have protection on your sales overseas, and I'm going to defer that conversation for just a minute and come back to it. An advised letter of credit would then be after that, and an advised letter of credit is one where your buyer overseas goes to their commercial bank, asks them to open a letter of credit in your favor so that when you ship, you submit documentation and you get paid against that documentation. When it's just advised through a U.S. Commercial bank, the U.S. bank is not adding its obligation to that of the issuing bank, and so you, the exporter, are still taking the credit risk of the bank that issued the LC, and you're taking the country risk of where that bank's located. So going back to a confirmed LC, if you ask that the LC be open and request the American bank to confirm, then the American bank, if they're willing to take that risk, would add its confirmation. So therefore, they take the credit risk of the commercial bank and they take the country risk. And so as long as you can do documentation in accordance with what the LC asks for, and you should get a copy of that LC in advance so that it can be reviewed, review it with your bank to make sure the terms and conditions, timeframes are all within what you can accomplish, and then that can work. And there's site LCs, which means it's payable upon presentation of documents, and there's time LCs. Time could be anywhere typically from 30 days to 180 days after shipment date would be the normal thing, and so you got to make sure your commercial bank's willing to look at that kind of risk, and if you need cash flow, those instruments can be discounted if the bank has added its confirmation. So a good way for you to help them purchase product, and a good way for you to get your cash flow out of it if it can do that. Now, when you look at some of the countries in Africa, there's some, again, looking at the credit and so forth, some banks are less likely to want to handle transactions out of those areas of the country. We have some clients that we have assisted in an Indiana client actually that's exporting to Ghana and Kenya, and we've done some fairly sizable letters of credit for those. And if we're uncomfortable, we have the means to look at other methods to help us get comfortable with the risk that we're taking, either country or credit or both, depending on how we look. The Ex-Im Bank, the Export-Import Bank of the United States, would be one where we could try to ensure that. Or what we've done more so is to use a World Bank entity where we will lay off risk to the World Bank entity They have the International Bank for Reconstruction and Development, known as IBRD, the International Development Bank, IDB, and the International Finance Corporation, IFC. And so we will work with those entities to maybe lay off, and they're going to then take on that risk for us. And what it does for you, the exporter, is that you get to deal with your bank, your commercial bank that is used to working with you, working with your documentation and processing it. And so it's a means to be able to make those sales and go smoothly. Sometimes the African Development Bank can get involved as well. It's known as the ADB, and they can help support transactions also. There is a timing issue. Thank you, Vicki. I'm normally pretty loud, so most people don't have to worry about me using a mic. Now I lost my train of thought here, Vicki. Thank you. There is timing issues around when you ask for a letter of credit type protection. If you got a specialty made product that you're making, do you get that LC before you start the manufacturing process, or do you wait until you get closer to the shipment, which your buyer is going to want to wait because there's a cost on them to open the LC at their commercial bank, and the later they can defer that, the less cost they have. But the issue comes around, and this has happened to our client, where they did the manufacturing, and that equipment has sat at their office for now, I think, going on a year because they haven't been able to get the commercial LC from, in this case, it was Ghana. And I think now it's just in the process of coming. So, you know, there's a lot of money tied up in the manufacturing of the product. And so you want to make sure you manage that the best you can and work with your bank to help you try to do that. If you're have a higher risk appetite individually, you might consider selling on documented collections. That's where you make a sale, you do your shipment, you submit your documents to the bank, send them overseas, and ask that the documents only be released against payment. And that way you've kind of controlled the flow of cash. If you're using ocean bills of lading consigned to order of the buyer, it's important that you use negotiable ocean bills of lading, and they're only negotiable if they're consigned to order of the party you're selling to. That way, if it flows through the bank's not supposed to turn over the documents until they get payment. I would highly advise, if you're worried about risk at all, to be careful if you're selling on terms, because all they have to do is say, yeah, they agree to pay at the end of the terms, but the bank is not obligated to make that payment on their behalf. So if they don't pay, then you'd still have some issues. And then the least advantageous is true open account sales that you make to a foreign buyer. And so if you're making open account sales, you're shipping your product, you're sending them the documentation, you're waiting to get paid, and hopefully they pay on terms, but if they don't, then you've got no protection against that. And so how can you look at that? What can you look to do? You might be able to get credit insurance to support your sales. I don't know a lot of private sector insurance companies that are insuring in the African area of the world. Exim Bank is open. They do business. They have a country limitation schedule, which spells out what they're willing to do. If it's consumable type products, they can go up to a year in coverage. Mostly they like to stay in the 90 to 120, but they will, in certain situations, go up to a longer thing. And many times for Exim Bank to cover risk, they're going to, in these areas of the world, they're going to ask that there be a commercial LC issued to support those transactions. And if it goes to medium term, where you got capital goods that you're selling, Exim Bank will probably most likely want the Ministry of Finance or the central bank to sign off and be obligated. They'll want, before they even make a commitment, they're going to want that there be a letter from those entities stating that they are prepared to support the transaction, and then they'll physically have to be a guarantor on the transaction in order for it to be done and to be financed. If you're a company that's in need of working capital for your export activities, my panelist here is going to talk a little bit about the SBA, but the Ex-Im Bank has a program as well. It's called the Ex-Im Working Capital Program that you can tie in through your commercial bank. You don't work directly with Ex-Im Bank. You work through your commercial bank for them to be able to obtain that coverage. And what it really does is it allows the U.S. bank to be protected up to 90% of the loan value that they're making to you. And so it's a protection to the bank and not a protection to you, but it does give you a chance to be able to use your assets, leverage your foreign assets, foreign receivables, foreign inventory for foreign purposes to be able to get coverage to do that. In some instances, you might be required to have to issue a bid bond to win a deal, or a performance bond, or very seldom in that area of the world would you be getting advance payments, but you could get advance payments. And then there's warranty bonds that you might have to issue. In our case, we issue standby LCs for that purposes. Sometimes we have to issue through a commercial bank in the country for them to actually issue that performance bond or bid bond. So Ex-Im Bank's program, if you're using the working capital program, you can leverage assets because collateral coverage on advance payments, bid bonds, performance bonds, you only need like 20% collateral coverage. Warranty bonds, you need 100% collateral coverage, and 25% of that has to be cash. And so there's some requirements around how Ex-Im looks at that, so I'd suggest that you talk with your commercial banker. And I guess I've done about my 15 minutes. Tom's going to come up and introduce our next speaker.
All right. Thanks, Randy. I've heard variations of that conversation a lot of times over the years. Our next speaker is Ashley Bubna. She's with the International Trade Specialist with the U.S. Department of Commerce. Ashley is the International Trade Specialist for the Horn of Africa and the islands of Madagascar, Seychelles, and Comoros. She works with governments to open new markets in Africa for American exporters and eliminate trade barriers. Ashley is an advisor on the African Union and trade agreements, including the U.S.-Africa Trade and African Growth and Opportunity Act. She also serves on the President's Advisory Council on Doing Business in Africa, right on target for this presentation, and on the department's working group on smart cities. Ashley previously led trade promotion delegations of U.S. companies in the energy, healthcare, and safety and security sectors, and served at the Foreign Agricultural Service of the U.S. Department of Agriculture for trade policy and capacity building for Latin America, Asia, and Africa. She holds an MA in International Peace and Conflict Resolution with a concentration in U.S. foreign policy from the School of International Service at American University. I'll turn the floor over to Ashley.
Thank you. I'm going to try to do my presentation up here so I can keep with my panel members. So let me know if you're having trouble hearing me. Actually, let me see if I can. So hi, I am Ashley Bubna. I work with the Commercial Service in Washington, D.C. The Commercial Service is an important part of the Department of Commerce's International Trade Administration because we increase the competitiveness of U.S. companies. We promote trade and investment. We ensure fair trade and compliance with international trade laws. So as a desk officer in the Office of Africa, my job is to basically advise on trade policy for the organization for the Horn of Africa and various parts of East Africa. So Before I kind of get into some of the financing mechanisms that the U.S. government has for exporting to Africa, I kind of wanted to sort of reinforce what some of my earlier panelists were talking about in terms of the African market, some key trends. So I'd like to start off by saying that, as we've heard from David this morning, Africa has seen rapid growth over the last decade. It constitutes 19 of the 25 fastest growing countries in the world. Countries like Tanzania, Rwanda, and Mozambique have seen over 7% GDP growth in 2015, and Ethiopia had a whopping 10.5% GDP growth rate. So as you should know, 7% GDP growth rate is what's needed in order to reduce poverty and achieve their Millennium Development Goals in Africa. So a lot of countries are right on track with that. However, in the last maybe year and a half, we've seen those GDP growth rates slow down as a result of falling commodity prices. So a lot of countries that are sort of tied to commodities for their GDP are sort of trying to diversify now and get into other sectors. So you're seeing places like Nigeria and Ethiopia, they're really trying to get away from dependence on natural resources and diversify their market. So I'll use Ethiopia as an example. They are big exporters of coffee, and so with the volatility of coffee prices, they are trying to diversify and actually become the new destination for light manufacturing. So they've opened up a big industrial park and a big U.S. company, PVH, which owns like Tommy Hilfiger, Calvin Klein. They've moved into that complex. It's an $85 million complex in order to take advantage of the African Growth and Opportunity Act, AGOA, which has preferential trade agreements for textiles in order to do a lot of textile manufacturing. So Ethiopia is kind of becoming now a destination market for that in its efforts to diversify its economy. Another big piece that I wanted to sort of point out is that the global population growth between now and 2050 is anticipated to more than double, by which time Africa will hold 25% of the global population by 2050. That is huge. And that really goes back to a point that Shakira made about sort of this young youth population. Africa really is becoming a destination for a lot of manufacturing, especially light manufacturing, because of the available workforce and the prices of labor. Consequently, because of this giant demand that's being created from the skyrocketing population, there's huge demand for infrastructure and consumer goods. So this will rise in order to accommodate the skyrocketing population. So infrastructure financing needs are estimated at around $90 billion per year through 2050. Africa is also home to the world's fastest growing middle class, estimated to grow from 123 million in 2012, so approximately 13% of the continent's population, to 1.1 billion in 2060, constituting 42% of the continent's predicted population. That is massive. And as you know, middle-class economies are inherently more consumeristic, so they buy more, aka buying hopefully more US products. So this will translate into greater consumer spending, which is predicted to increase to 1.4 trillion just by 2020. So that's 3 years from now. And US products are perfectly positioned to meet Africa's increasing demand. So demand for high-quality American products and services is strong in Africa, especially in the energy, healthcare, automotive, aerospace, finance, transportation, IT, and franchise sectors. US brand recognition is amongst the highest in the world. 7 out of the 10 most popular brands in the world are American. So as you can see, Africa offers immense opportunities for US exporters. But as we also heard, there's immense challenges in doing business in Africa. The lack of infrastructure, most notably electricity, a lack of broadband internet, a lack of roads, a lack of predictability, a lack of harmonized regulations, the lack of sort of structures in place to do cross-border trading is very difficult in Africa. And so along with the immense opportunities, there are challenges, which is why it's critical that there are financing options that will lower some of the risks that are inherent to sort of doing business in Africa. So I want to take that opportunity to discuss that now. So there are 4 types of US government financing programs. So there's export development and working capital financing. There's facilities development financing. There's financing for your international buyers. And there's investment project financing. So let me first start off by telling you a little bit and breaking down what export development and working capital financing really means. So this is the financing that you need for when you need cash at hand to sort of grow your business, accept new business. So when you're an existing business, you have a finite amount of cash. If you want to grow your business, that means you need to buy new raw materials, you need to hire extra people for labor costs in order to develop and to manufacture those products. So you need something called working capital to help you get that extra money so that you can buy the extra supplies, hire the extra labor in order to grow your business. And as my colleague Eric will be able to tell you a little bit later, the Small Business Administration has a program called the Export Working Capital Program. So what they do is they will guarantee loans that commercial banks like PNC will make on U.S. small business exporters for short-term transaction-specific working capital loans. So basically what this means is that if a U.S. exporter defaults on their loan because of buyer insolvency or some other issue that sort of the deal falls through, the U.S. exporter, they've already started manufacturing this product, they've already bought the raw materials, they've already added the extra labor force, they've already incurred costs. And so when they sort of default and they're not able to pay back the debt from the amount of money that they've already spent, SBA will go in and will pay up to the $5 million for the loan back to the bank like PNC to cover that cost. So it really takes away a lot of the debt or a lot of the risk that U.S. companies are facing working in a challenging market like Africa. Okay. And Exim Bank, the Export-Import Bank, also has a similar type of program where they also provide working capital guarantees for exporters' commercial loans. But sort of unlike SBA's program, which is tailored for small businesses, they don't have a minimum or maximum transaction account. So this is same thing. If an exporter defaults on a loan, then Exim Bank will come in and under this guarantee will reimburse the lender for the guaranteed portion, thereby sort of taking on the risks themselves and taking the risk from the lender. So oftentimes lenders, will feel more comfortable than lending once they have this guarantee that they're going to get paid, and the guarantee is made by Exim Bank. And they generally pay, which Randy pointed out, 90% of the loan. They'll pay that back, and so the company, the U.S. exporter, will retain 10% of the cost that they still have to pay back. So they still retain some percent of the risk, so they still have a little bit of skin in the game on that. The next one is another SBA program, Export Express program. So SBA gives lenders sort of unilateral ability to approve loans under $500,000 in about 36 hours or less. Is that about right? 36 hours.
Can be same day.
Can be same day. So it's a small denomination of money, but if you're just starting out and exporting and you get a sudden order, or sometimes you have rush shipments for things and they want it the next day or they want it 2 days from now and you need to get started, this is a great way to get quick cash to get started on the process. Although there are eligibility requirements, being that this is especially tailored for small businesses, they have to be in operation for at least 12 months, although this can be waived if they're able to show an export's expertise already. And so this loan can really be used for all business purposes, including expansion, equipment purchases, working capital, inventory, all sorts of things. And the next type of U.S. government loan financing program is facilities development financing. So this is for financing for U.S. businesses to acquire, construct, renovate, modernize, improve, and expand facilities and equipment to be used in the United States for the production of goods and services for international trade. So these are basically going to be loan and guarantee programs for companies that want to expand their physical presence. So they want to renovate their building, their facilities, they want to expand onto it. So these are loans that are tailored and guarantees tailored for that. So SBA, again, has a international trade loan program. So it will guarantee up to $4.5 million in combined working capital loans and loans for facilities and equipment. So like I said, including construction of facilities, renovations, improvements or expansions. However, this money cannot be used to actually purchase a business. You already have to be an existing business. This is not to buy the business license and all of that. This is just for, I'm housed in Indianapolis and I want to grow my business and set up shop in Philadelphia. So this money is going to help me build another factory or another presence in Philadelphia. And it will guarantee, SBA will guarantee this loan up to $4.5 million. Oh, sorry, missed the slide. Okay, so the next one, which I think in talking about Africa is really critical, it's financing for your international buyers. So this is financing enables U.S. businesses to assist their international buyers in locating financing to purchase U.S. goods and services when financing is otherwise not available, or there's no economically viable interest rates on terms over 1 to 2 years. So this is often a problem, especially when there's high-value goods or there's infrastructure projects. It's really difficult for African companies to get medium or long-term financing needed from commercial lenders in order to finance those big projects. And commercial lenders are hesitant to sort of lend such large sums of money for such long periods of time when a lot of things can happen in the interim to foreign buyers, especially in developing countries. And so this is a program it's very important, and it's slowly becoming more and more utilized by foreign buyers. And it's often a problem when you have U.S. companies that locate a foreign buyer. There's the willingness, there's they have the ability to buy, but they still need financing, especially for such large projects. So they don't have the solvency to be able to buy cash in hand, so they need these loans. But they don't have, in Africa, many countries don't have highly sophisticated or highly developed banking systems, and they have problems with solvency, and so they don't have the ability locally to give out these different loans, especially for large loans and long-term loans. So that's where the U.S. government comes in and helps. So the Exim Bank has a loan guarantee program. So in the same way that Exim and SBA will guarantee exporters' loans, they also offer guarantee to creditworthy international buyers of U.S. goods and service loans. So Exim does this in order to encourage U.S. banks and other lenders to provide loans to creditworthy foreign buyers of U.S. goods and services. So like I said, there's a critical need for this type of banking in Africa due to the shortages of liquidity and the underdeveloped banking systems that really make it difficult for especially small local African companies to buy U.S. goods and services. And a lot of the discussion here today has already been on, when you first think about financing, you think about Africa, you think of large infrastructure projects, but there's also a lot of projects that are created from the supply chain from those big infrastructure projects that small U.S. companies can really benefit, and there's an immense opportunity for that. But there's still a lack of capital in a lot of African markets for those local African companies to be able to buy products from U.S. companies. So, but if they have this loan guarantee program, they can, U.S. banks can give them the loan, and then Exim Bank will guarantee those loans to those foreign buyers of U.S. goods and services. But they have to be a buyer, of course, of U.S. goods and services to qualify for those loans, or for the guarantee. And of course, what goes hand in hand with that is they actually give direct loans. So not only will they guarantee a U.S. commercial bank's loan that is made, they will also provide direct loans to foreign buyers in order to be able to purchase U.S. goods and services. So they do this in both the private sector and public sector. So they will also provide loans to governments. So oftentimes when you're looking at these big infrastructure projects, they are to African governments, and that's a lot of where a lot of U.S. businesses is actually happening. So Exim Bank will provide a critical source of financing to the private sector, the public sector as well. There is no minimum maximum size of the export sale that can be financed. However, there is a U.S. content requirement. And so we get a lot of questions when companies come to us and they want to do business in Africa and they're trying to get EXIM financing or they're trying to get for their local buyers. And that is something that sometimes we have trouble with, is that there is a content requirement. So for small businesses, if the U.S. content of any product is 50% or less, then the loan can also EXIM can only finance loans, the part that is the actual U.S. content. So only U.S. content then is eligible for EXIM financing. For medium and large businesses, you can't even get financing unless your U.S. content is more than 50%. And so EXIM Bank doesn't only do loan guarantees and actual direct loans. They will also provide a guarantee for leases. So you don't always have to buy a product or buy a service. You can lease a service just like you can in the US. So you can buy a house or you can lease it. So EXIM provides guarantees for the same thing. So if foreign companies or foreign buyers, they want to lease US aircraft, then EXIM Bank will also provide a guarantee till the end of that lease to ensure that payment is received. And if the U.S. or if the foreign buyer defaults, then on that loan, EXIM Bank will reimburse the commercial lender of that loan. So therefore taking on the risk. And there's one more, which Elliot rightly pointed out. Investment in Africa is critical, and it's a great market for getting in early. And there's definitely a lot of risk inherent into investing in Africa, but there are sort of safeguards that through U.S. government programs in order to alleviate some of that risk. So that's why the last thing I want to talk about today is U.S. government financing programs for investment. So this type of financing enables U.S. businesses to acquire financing for investment in large-scale projects that require large amounts of capital, such as infrastructure, telecommunications, power, water, housing, airports, hotels, high-tech financial services, and natural resource extraction industries. So the Overseas Private Investment Corporation has small and medium enterprise financing. So they provide medium to long-term funding through direct loans and loan guarantees to eligible investment projects in developing countries and emerging markets. So this is their way of encouraging U.S. investment projects overseas by offering political risk insurance, all risk guarantees, and direct loans. So basically, they understand there's going to be inherent risk in doing business in Africa, and so this program takes out a lot of the risk for doing business in Africa if you sign up to participate in any one of these programs. And Africa still offers immense opportunity, and it should be noted that foreign investment in Africa, McKinsey found out in one of their latest reports, yields the highest rate of returns of all emerging markets. So even though there is still substantial risk, given all the volatility in political situations, currency and convertibility, political violence, unlawful government interference. There's a host of issues, as there are in most developing countries, but there are programs that were devised in order to safeguard U.S. companies from these sorts of issues. So OPIC offers these programs to 160 developing countries and post-conflict countries. So there's a great example, actually, for Ethiopia. So recently they went through, there was a U.S. company, and it had political violence insurance. So that's one of OPIC's biggest programs, is their political risk guarantee, or political risk insurance. And there was recently a state of emergency. There was a lot of political instability caused from protests and things like that were happening in October of last year. And so the Ethiopian government issued a state of emergency, basically shutting down some U.S. businesses from coming into Ethiopia because of travel restrictions. And during some of these protests, some companies, a lot of foreign companies were targeted. and one U.S. company was actually targeted, wasn't targeted, but was part of the sort of the destruction that resulted from it. And they were able to utilize their political violence insurance that they had through OPIC and actually get reimbursed for those damages that were incurred during the political violence that was happening at that time. So it's definitely something, if you're doing business in countries that seem stable, and sometimes things can happen overnight, it seems like, it's definitely something that companies need to look into if they're thinking about doing business in Africa, especially in countries and markets where there is a history of political conflict or any type of conflict. It's something that it's definitely a good thing to look into. So if you want any more information about these various programs that I'm sure my colleague will talk a little bit more about, there's a listing of all of them on export.gov. And I also encourage you to reach out to your local Indianapolis Export Assistance Center. We have our representative here today, Mark Cooper. He is located here in Indianapolis, and so he's your first point of contact for wanting to get into exporting to Africa. And please also contact myself or any of my colleagues in the Office of Africa if you have any questions about the market and wanting to know sort of what the political situation is, what the economic situation is in any countries in Africa.
Thank you, Ashley. Our third speaker today is Eric Armacost. He's a lender relations specialist and district international trade officer for the Indiana District Office of the Small Business Administration. He joined as a lender relations specialist in October of 2012, and since then has enjoyed building and growing relationships with lending institutions and providing technical assistance and training to borrowers, lenders, and resource partners. He brings more than 16 years of banking and financial services experience to the SBA and calls on skills that he gained at Merrill Lynch, JP Morgan, and the U.S. Navy. Thank you for your service. My brother was in the Navy too. And he does that to provide outstanding client experiences. As a veteran of the U.S. Navy, where he served as a radio man aboard the USS Kavala, he relishes the opportunity to work with the military veteran entrepreneur community in Indiana. He's also been proud to serve as the SBA Indiana District International Trade Officer for the past 3 years in support of increasing exports from Hoosier small businesses. Eric?
Thanks very much, Tom. I appreciate it. Can you hear me okay? Great. So thanks very much for being here today. I know everybody here is busy. I also want to really thank my colleagues for being here and providing their expertise. I just want to briefly provide an overview of the Small Business Administration. We're a cabinet-level agency established in 1953 with the mission of supporting and sustaining small businesses across the U.S. So that's kind of an amorphous mission. We do that through overseeing or managing what we call the 3 C's. So that's contract opportunities to the federal government. We oversee a network of counseling agencies that meet with small business enterprises for free or at very low cost to provide technical assistance and business counseling, and then capital support programs. So this is the capital support program or section of this program. So I want to kind of focus on that a little bit. Now, my new friend Ashley dwelled on some of the programs that offered by the SBA and also by Exim Bank, and we heard about the International Development Bank and the World Bank and some of these other components. And the key thing I hope you take away from this conversation today is that international trade finance can be a little more complex than domestic financing. We haven't even really talked about currency risk, and that's another factor that comes into play. The key thing on that, though, is to know we're all on the same team, right? So we may not be able to give you the specific answer for your specific financing needs today, but it's important to know that whomever you end up connecting with here, if you have a complex financing need, we're probably going to talk to one another and say, okay, so we've got this situation and we've got a financing need that looks like this. What are the tools we have in our toolbox that we can bring to bear on this problem? And by and large, in a very collegial manner, we'll work together to arrive at a financing solution that meets your needs. The SBA's role in that primarily is to act as sort of a clearinghouse in terms of connecting you with the resources that are available. So for example, I have to say I am not an expert in trading into Sub-Saharan Africa. What I am an expert in is working with my colleagues in the private sector to help find guarantee solutions and other solutions that'll make capital available where maybe it otherwise would not be, or if it would be available, maybe not on very favorable terms. And we also connect with our colleagues at Commerce to get technical support and logistical support. And earlier, somebody mentioned the Gold Key program, and if you're interested in selling into a non-U.S. market, I have to say that appears to me to be one of the best values going. And I won't steal Commerce's thunder on that, but I would strongly recommend that if you're looking at expanding into a non-U.S. market, that you consider the Gold Key. In closing, really, I want to just reiterate the fact that while we're a federal agency, the Small Business Administration has a district office here in Indianapolis. My contact information is on page 7 of this magazine that's on your table right there. So rather than dwelling on the specific technicalities of the different loan programs, I would encourage you to not worry about that so much. Just know this: if you have a financing need and you contact either a private sector lender or you contact our colleagues at the the U.S. Export Assistance Center, we'll talk and we'll find a solution that works to fit your need. Thank you very much.
Eric teed up currency risk, so I'm just going to comment on it only briefly since I work in the world of foreign currency for PNC. If we had the map that Ashley had up there before for Africa, you'd see that there's a lot of countries in Africa. And there it is. There's a lot of countries there in Africa. And as it relates to the ability to trade in those currencies, at least to the corporate side of the bank that I serve at anyway, there's a lot of limitations. Of the approved currencies that we trade in, where we can actually pay on behalf of U.S. corporates, outbound currency payments, it's limited not just to Sub-Saharan for that, but limited to all of Africa. It's limited to Ethiopia, Kenya, Morocco, Uganda, South Africa, Zambia, Egypt, Mauritius, Malawi, and Nigeria. So pretty limited relative to the scope of all that. And then really, of all of those currencies, there's really only one, and that would be the South African rand, which is a currency that is approved really for hedging, for like risk management related tools, outside of just regular, what we would call spot payments. The rest of those currencies would be one where a bank client might come in and say they need to make a payment in a specific currency. Today, we would provide an exchange rate based on where the market is trading right now, and then pay that currency outbound. One of our speakers who had to cancel last moment does frequent payments with us to Uganda, and of the services that we provide, of course, as a large corporate bank that's a big player in the FX market, is very competitive exchange rates, strong advice as it relates to opportunities in the markets, trends in these currencies, and the like. And we also deal a lot in Kenya, at least in the markets, again, that I serve, and certainly in South Africa as well. So as you consider that as another challenge amongst all of these different challenges that have been discussed here and opportunities, foreign currency is something that definitely needs to be considered. It needs to be contemplated around all the international sort of financing risks, and then bring experts in to really help you kind of contemplate all the various components of making these payments, whether it be in the foreign currency or in the U.S. dollars. So to that, we have a microphone, and I'll pass it around as soon as somebody raises their hand. Questions for the panel? Anybody like to go first? All right. That's okay.
Hi. My question is we've talked about this with a couple of folks earlier before your panel. So we tend to, as a society, as a business people, tend to talk about Africa as a single entity. But we all know that Africa is much more complicated than that. And so for a small business or small medium enterprise who's looking at that large map and going, I know there's differences, but I don't even know how to take a bite of that. What recommendations would you give for them to look at that in steps and to be able to conquer it?
I would say just initially, our colleagues at the U.S. Export Assistance Center with the Department of Commerce here in town would be a fantastic place to start. In addition, for small businesses, there's a network in the state of Indiana called the Indiana Small Business Development Center. I believe their contact information is on page 11 or so in this magazine. They have a specialist that works exclusively with small businesses on gaining technical knowledge about exporting into foreign markets. That would probably be a good place to start because they can help try to define and get maybe some metrics, although my understanding is maybe the metrics aren't the be-all, end-all that they would be for, say, a domestic market, right? So, but it's a good place to start to gain some information and at least narrow down the options.
I would say as well, so the U.S. Commercial Service puts together a country commercial guide, and so the Foreign Service officers in each post, they will put together this guide, and they have it divvied out for different sections for different industries, and so they will go out and tell you what industry is good for that particular market, what the constraints are, what the opportunities are, and sort of what are the risks that you're facing. And so if you have a particular product that you're looking to export, it might be hard to figure out within all 54 countries which one to start with first, and that's who, Mark, if you work through the U.S. Export Assistance Center, they can help you, they can contact us in the Africa office and post and see sort of where to start, and then you can look at those country commercial guides and really get a more detailed analysis of what the opportunities are for your particular product, for that particular market, what the political risks are, and how the economy is doing. And it also does some forecasting, so you'll know whether this is going to be a good market for you in 5 to 10 years, not just for this year. Because as we all know, sort of market opportunities can sometimes change rapidly in Africa, so you want to make sure that any market that you are going into, that it has long-term chances for success for your particular product.
This question is for you, Mr. Miller. I'm curious in terms of those currencies that you listed. How is that determined? I mean, just basically a market forces that determine that. What will make Ethiopian's currency more favorable than, say, what is done in Rwanda or someplace like that?
Decisions around what are approved currencies at the bank are ultimately determined just by risk management parameters. Accounts where we will either choose through demand to open what we call a nostro account, or it's an account at a foreign bank where we would actually maintain balances in that currency to receive payments on behalf of bank clients or make payments outbound on behalf of bank clients. We can open accounts at foreign institutions. In other instances, currencies can be also traded on what we call a third-party basis, so through another bank. So we would provide an exchange rate through a relationship that we would have with another bank, and then, of course, leverage that relationship to provide a competitive and effective exchange rate. And there's different entities that provide these sort of third-party relationships, and in certain instances, those are again, based on demand and based on opportunities in those markets around restrictions. There's a lot of government restrictions in certain currencies as well that'll limit our ability to trade in those. And then, so the freely tradable hedged currencies like South Africa are really just based on broader currency dynamics as well. So in a lot of cases, and this is where someone like in my position can provide good guidance, it just makes more sense to honestly make a payment in US dollars because of the way that it's routed through the banking system. There are instances in Africa, certainly we've run across these in Uganda as an example, where the receiving bank will hold on to funds for a period of time. And it's then incumbent upon our operations team, our back office investigations team, to determine why those funds are not being credited to the beneficiary. And there's a lot of communication that occurs in that regard. So, the world of currency is, it's very dynamic, and there's a lot of, outside of just the concept that we should be able to just simply make a payment and a transfer. I think we've all kind of gotten used to the world of technology where that seems very easy. But when you get into different banking environments, different government regulations, there's a lot that really needs to be contemplated and managed through that process, and that's where banks and foreign exchange departments can help.
And my question is, when you qualify the vendors or business during the qualification process, do you also help assess or weigh the risk of that particular purchasing or exporting?
The bank doesn't really get involved in analyzing the risk of your counterparty overseas. That is something that you would have to work with your CPA firm or a law firm on how you want to look at that risk. And what we do get involved in is if you decide to use a commercial letter of credit to ship against, then we do analyze the risk of the bank in the country and decide whether or not we want to take that risk. And so that is a bank risk that we judge. If you're looking for us to finance something using an Ex-Im Bank program, if it's medium term, then we do get the financial statements of the buyer. We do our own analytics of that buyer to see if they would qualify to be submitted for approval by Ex-Im Bank for that financing on a medium-term basis. And as Ashley pointed out, on medium-term deals, the bank will only finance U.S. content. And so if you've got $1 million deal, 15% of that's going to have to be paid up front. And so that's $150,000. If you had foreign content of $150,000, that could go against the down payment, and so the rest of it could be financed. So there could be ways to get pieces of foreign content covered in a medium-term type transaction. You just need to work through those processes with your bank to help them guide you through what that would be. Ex-Im Bank right now is in flux a little bit, and where their charter has been renewed, I think, to September 2019. However, they don't have a permanent president yet. They don't have a full board. And because they don't have a full board, they're limited to $10 million. And as Ashley so rightly pointed out, infrastructure is a big need in Africa. And for U.S. companies to be able to compete effectively, they need to get support to do those projects. We have a client that was trying to do something in Cameroon. And it was a $40 million project. They were hoping to be able to do it in tranches to try to keep it under the 10 million hurdle, but Ex-Im wasn't going to allow that either because they're going to look at the total debt exposure to the entity that was doing that. And so that didn't work under that circumstances. So I would encourage all of you to write your congressmen and senators to talk about the importance of Ex-Im Bank, why it should be renewed. It's not there for the Boeings and the GEs of the world, although they do use the program, which is also good for the U.S. and having balance of payments. The tax dollars earned from those exports still has great value for those large companies, but there are tons and tons of smaller companies that take advantage of the Ex-Im Bank programs that our senators and congressmen need to understand. We would be, if they end up not renewing the charter or getting it back into full force, we would be the only major developed country not to have a government support program, and just think what that would do to help U.S. exports. So it is critical that our politicians start to understand the value of Ex-Im. And Ex-Im is actually the only, if not, maybe the only one, if not, it's close to the only one that actually makes a profit. They charge fees for their programs, and they send money to the U.S. Treasury every year. So it is a moneymaker for the government on top of the value it adds to you as exporters.
Hello, thanks for coming today. My name is Dan Preston. I'm on the faculty at in IU in Bloomington. I study international finance, and I had some questions about the costs associated with the facilities you've been talking about today. Just trying to get an example of what, for Randy, for what a letter of credit would cost, and Ashley, kind of what kind of interest rates are on these facilities for foreign buyers when it comes to EXIM. And then I have a second question for Ashley about, so if a foreign buyer defaults on the loan, what recourse does the government take to recuperate those funds? Thank you.
The costs around a letter of credit, there are just normal processing fees that are involved in a letter of credit. There's an advising fee, and that could range in the neighborhood of $150 or so. There's a document examination fee, which is typically 1/8 of 1% of the draw amount with a minimum of a couple $100. And these are round numbers. These are not quotes from PNC. I'm not looking at a price sheet here, so I'm not actually quoting anything. And then when we look to confirm a letter of credit, we're looking to see what the terms are. We'll look at the bank, we'll analyze the bank risk, we'll look at the country, analyze the country risk, and our pricing will be set off of that. And then if it's a site LC, you have just the confirmation fee, and I think we just quoted an export for an Indiana company at 50 basis points for each 3 months or fraction thereof was the cost that we gave this company to confirm their LC on a site basis. If it was a time LC where it was payable 120 days after bill of lading, then there would be an acceptance fee on top of that. And based on that quote of confirmation, I'm going to guess that that acceptance fee is going to be in the neighborhood of 2.5% per annum. And then if you wanted to get your funds out of the transaction, then we would look to be able to discount it to you, and that would be based off of LIBOR, so it'd be LIBOR plus a spread. That spread could be maybe 3/4 over LIBOR because you've already paid for the acceptance period. That's our risk period involved in the deal, and then there's some funding costs. So that would be kind of along that line. EXIM Bank has fees if they use their, for short-term sales where they're insuring the foreign receivable. There's a fee for the insurance, and they have it's broken down to whether or not it's strictly open account or if it's under a collection or a letter of credit, and the fees vary, and it varies based on length, if it's 0 to 60 days or 0 to 90 days or 120. There's different fee schedules for those, and I don't have EXIM Bank's fees to be able to quote that. If you're doing medium term, there's if you go to the EXIM site, and I don't have that. I don't know if you have what it's EXIM. Is it eximbank.gov? EXIM, just exim.gov. If you go to exim.gov, you can see. Look up what their some of their fees would be for medium term, and you could see their country limitation schedules as well in that. I'm going to comment, and then I'll turn it over and get Ashley's comment on if there's a default by a foreign buyer. You know, banks prefer companies that use EXIM credit insurance over private sector credit insurance, because EXIM Bank has the long reach of other government programs. So what they will do, they will make a world announcement that XYZ has defaulted on payment, which makes it very difficult for them then to get credit to be able to do other deals. And so they have a lot of power in the way they go about enforcing that. You know, if it's a letter of credit that was defaulted and the bank was just taking commercial credit risk, banks get a different place at the debt renegotiation table than you, the exporter. You don't really get a very good seat there, not at all actually, in order to be able to negotiate debt. So there's some value in having a bank involved in the middle of a finance deal. So that would be my comment on why commercial banks like EXIM Bank, if there's a default. And again, if you use the working capital program, that is a program that protects the commercial bank that's lending you the working capital. You, the exporter, still must repay that debt to the commercial bank, and if you don't repay it, the bank can file claim against Ex-Im Bank to be covered for 90%, but both Ex-Im Bank and the commercial bank is going to come in and start to foreclose on the collateral that was used to try to back that. So you don't have your debt eliminated if there's a problem in getting paid, if it's just on the Ex-Im. So you need either credit protection or some other kind of financing, LC protection or whatever, if you're worried about your commercial risk and you're using a working capital program. You want to comment on?
I mean, I think you covered it pretty brilliantly, but I think that, the power sort of with Ex-Im is that it is a U.S. government entity, and so we have multiple sort of methods. We also have the commercial diplomatic method that we go through, and we actually contact relevant stakeholders in the ministries in order to be able to resolve these issues of sort of non-payment. So we also go down the commercial diplomacy route. So Ex-Im, being that it's a government institution, has that additional benefit. And so that's why a lot of times banks will like to have Ex-Im as a guarantor for a lot of their loan programs, because if they do happen to default, if the exporter defaults or if the international buyer defaults, there's the weight of sort of a government institution like that to get the money back.
Well, in the spirit of punctuality, we are exactly 12:30. And so at the end of this panel discussion, before we move everybody off to lunch, I'd just like to point out that on your tables you do have some surveys. I've been asked to ask you to take a moment to fill out the survey before you depart today, so please do so. And then with that being said, lunch is on the side table. Feel free to take some time to enjoy some food and network. Thank you.